From the opinion pages of the Wall Street Journal, this is Potomac Watch.
Inflation hits 9.1% year over year, the highest since 1981, as the White House plays more economic defense. Welcome, I'm Kyle Peterson with the Wall Street Journal. We're joined today by my colleagues, columnists Joe Sternberg and Kim Strassel. Welcome to you both. Let's start today with the White House's effort to get in front of today's inflation figure. Here is what White House Press Secretary Karine Jean-Pierre said on Tuesday.
So on Wednesday, we will have new CPI inflation data, and we expect the headline number, which includes gas and food, to be highly elevated, mainly because gas prices were so elevated in June. Gas and food prices continue to be heavily impacted by the war in Ukraine. And there are a few important points to keep in mind when we get this backwards-looking data. First, June CPI data is already out of date because energy prices have come down substantially this month and are expected to fall further. The average retail price of gas was 11% higher in June than it was in May. And the cost of gas in July is already down 7% from the June peak.
So that's the White House's pre-buttal, I suppose you would say. But now today we have the actual figures, and year over year, the consumer price index is up 9.1% in June and is really across the board in all sorts of categories. She's right that gas is an eye-popping one, 59.9% year over year increase. And Joe, it does seem like that gas prices in recent weeks have come down a little bit. And so, maybe we will see a smaller figure for gasoline in the next month. But what do you make of these figures and the White House's spin on this?
Well, Kyle, no wonder the White House wanted to get out ahead of these numbers because they are objectively pretty bad. Now, they're absolutely right that this data is always backward looking to a certain extent because, you don't have inflation data for what is happening to prices right this minute as we're speaking or as people are listening to this. But I think that definitely that is, to put it very generously, an optimistic take that we're getting from the White House, because the thing that struck me looking at these numbers is all of the things that aren't energy or gas prices that are in there. And the picture that emerges if you look at things like goods prices or services prices and price movements of various categories within both of those broad headings, clearly we are still in a situation where the inflation is pretty deeply entrenched at this point. And I think that, to the extent that we are going to see some relief on gas prices in July or subsequent months compared to June, which was particularly bad, that's going to help. That is not going to be any kind of a substantive cure to this problem, which is now well beyond the energy or the food prices.
And one thing I would also point out is the figure for core inflation, and that's less energy and food because those are volatile categories. So economists look at core inflation to get a better sense of the underlying trends. And year over year, core inflation is up 5.9%. But there's an interesting wrinkle here that I would point out. So the White House today, this morning, has a statement out on the CPI inflation, and I will read a line from it. It says, "Today's report shows that what economists call annual core inflation came down for the third month in a row and is the first month since last year where annual core inflation rate is below 6%. And why I think that is interesting is if you look at the monthly core inflation figure, in June it was up 0.7%, and that's an increase from May, 0.6%. Also, April was 0.6%. And so there are two different ways of cutting these statistics, and the Biden administration is looking at the year-over-year figure. And why that's going down, it seems to me, if I'm reading this right, is that we had some pretty high figures in April and May and June of 2021. And so as we get a month on, one of those previous figures from a year ago drops off and lowers the year-over-year rate. But remarkably, Kim, if you look at the monthly rate, it looks like the core inflation went up in June. And so, I can't begrudge the Biden administration, I guess, for picking the statistic that best suits its theory here. But it is interesting to me how you really have to dig into these numbers to figure out what's going on.
Yeah. You you heard from that statement that they are desperate to put the best spin on this. And also, I would just flag the other goal of that was to continue to suggest this is all Putin's price hike as the argument for why we're in the situation we are in. But the number that really should matter more here, as Joe is pointing out, we can't have a real-time analysis of where inflation is at. But you do want to look at where it is most recently because that is the best indicator. And so, as you know, when you're looking at those year-over-year prices, 5.9%, slightly less than 6%, it's because inflation wasn't as bad last fall. And as you note, one of those months has dropped off. But then we've got the month to month, and that is showing that we are still basically running at inflationary levels that are too high and that they continue. And in fact, there was even a slight uptick in the recent figures. So those are the things that the economists are going to be looking at. And that's why everybody should be a little bit concerned about where we are right now.
Joe, how do you think these figures will affect the thinking at the Federal Reserve when it meets in a couple of weeks and tries to figure out what it's going to do for the next rate increase?
Well, I think that this is definitely continuing to highlight a sense of urgency and a recognition on the part of the Fed that they are somewhat behind the curve in dealing with inflation that has now gotten to this extraordinary rate that we've seen in today's release. And so, I mean, as a first order of business, I think that they are not going to be deterred from the accelerated tightening pace that they were talking about already. So, I mean, you'll remember that the last time that they met, we ended up getting a 0.75 percentage point rate increase, which is very, very unusual for them. They usually prefer to move in 0.25% increases. So we're almost certainly going to get a 0.75% increase at this upcoming meeting too. And in fact, you're even starting to see some speculation among observers out in the market that it could be as high as a 1 percentage point increase at one go, which truly would be an extraordinary step on the Fed's part and would signal how serious they are about this. So you still run into the problem of, is that actually going to be enough for inflation that has reached the level that it's at? Because, I mean, even if they do the 1 percentage point increase, there's still going to be many percentage points below the rate of inflation itself, which means that your inflation-adjusted interest rates are going to be negative, which is still generally considered very stimulative. And I think that there is a school of thought out there, which I would tend to agree with, that you need to have a positive inflation-adjusted interest rate out there before you can start having any hope of actually controlling inflation.
But Joe, I mean, I've heard Kevin Hassett, former Trump economic advisor, say similar things, that you need interest rates to be above the rate of inflation. I mean, what do you think that would mean for the economy on Main Street, given it seems like it would be a pretty big shock to the economic system? I mean, does that suggest that there is probably a recession in the offing?
Well, there is definitely a lot of concern about whether you need a recession in order to tackle the inflation out there. Now, I'm not necessarily sure that I would agree with an argument that you hear, particularly from economists on the left, that the recession itself is the thing that you need to cause because the recession cures inflation. I tend to suspect that if we're going to have recession, it's going to be a side effect. And the problem is that part of what you're going to end up doing as they increase interest rates is sort of reversing a lot of the financial excess that we've had on Wall Street, in the financial system over the past 15 years. And, that deleveraging process is the thing that risks the recession. Now, I think that there are ways that policymakers can try to ameliorate that. I mean, for example, you could be looking at various policy, reforms, energy policies, tax reforms that would make it easier for the economy to shift into more productive uses of capital at the same time that you're trying to pivot out of some of the less productive uses. But that doesn't seem to be the direction that we're headed right now. So I think that through one mechanism or another, there is a growing danger that we will end up with a recession happening along the path out of the inflation.
Another piece of the puzzle, it seems to me, is economists talk about inflation expectations and at some point it becoming a self-fulfilling prophecy. And Kim, I mean, we've talked in previous podcasts about union negotiations where they're getting cost of living adjustments in their contracts, companies that are giving out big raises. I mean, at what point do you think the expectations really start to dig in as we get into, a year or more of this kind of inflation and people demanding that their wages be brought to keep up with it.
We're already there, and you can see that in some of the other numbers that came out. For instance, companies continued to raise prices over this past month despite what was an actual real declining unit demand. And they're doing that either because of fears of more inflation, the expectation of more inflation to come, to protect profits, to be able to cover those labor demands that you were mentioning. Inventories are going to continue to swell here. Usually one of the things that companies then do to deal with those excess inventories is to slow down their production and to engage in layoffs. That's how you end up with those unemployment numbers and these questions of recession. The other problem is that you're going to see this, you are seeing this expectation side, as you noted, from the labor side as well. Real wages at this point have now declined about 7.6% annually. That is a huge hit to workers, which is why they are pushing so hard to get higher wages. And they still have some power in that the labor market is tight. There are more people out there looking for workers than there are workers to fill those jobs. But even with those wage hikes that you were seeing, again, real wages are falling. So this is also going to add into this as well, too, is that this inflation is going to continue to push people to reduce their consumption. Between declining wages and declining household balance sheets overall, obviously the market, 401ks, people are seeing a lot out there. The only way that you can kind of continue that consumption will be through savings, spending savings, but people are going to be less and less willing to do that. So again, you're going to have these inventories that are going up, people less likely to want to buy. That's how you end up getting some of the slowdowns and the right sizing, as it were, people getting laid off. That's how you get the basis for some of these recession fears you're now hearing people talk about.
Hang tight. We'll be right back. You're listening to Potomac Watch from the Wall Street Journal.
From the opinion pages of the Wall Street Journal, this is Potomac Watch.
Welcome back. Joe, let me ask you again about the prospect of recession, because another prominent public figure, Clinton Treasury Secretary Larry Summers, is talking about the need for unemployment to break inflation. And he says that this could take a year of 10% unemployment, or maybe 2 years of 7.5% unemployment, or maybe 5 years of 6% unemployment. And what do you think he's basing that kind of thinking on? And do you think that it's sound logic?
So I think that this is a pretty standard view that you hear from a lot of economists, particularly on the left, wing, but it's kind of a mainstream sort of Keynesian approach. And sort of the issue is, this belief that one of the big factors that pushes up the prices or the inflation are a tight labor market and the wage demands that fuels and that sort of thing. I mean, this was always expressed by the Phillips curve, which has been a very popular component of these discussions for a long time. Now, I think that the concern is this issue of whether that's actually true. I mean, what Summers is hinting at here is the suggestion that you need to go out and try to cause the unemployment in order to bring the inflation down. Since the excessive employment is causing the inflation, the unemployment will cure it. There isn't really a lot of evidence for that. I mean, in fact, we've had a lot of historical examples over the past 40 years, either of instances like the periods during the Trump administration when you had very low unemployment, but also very stable inflation. And then you had periods in the 1970s where you had very high unemployment, but also very high inflation. So, I mean, going back to the discussion that we were having a few minutes ago about recession risk, I mean, it's entirely possible that you will end up with some kind of recession as we go through this cycle. But I think that it's important for people to understand that that would be a side effect of the policies that would help to cure the inflation rather than part of the solution. And I think that that kind of distinction, it can sound a little picayune, but it's important because it helps you clarify political accountability. If you kind of understand what's the cause, what's the effect, and what's the side effect here, you aren't necessarily going to be as willing to let politicians off the hook if it turns out, you can make an argument that the unemployment didn't need to be as severe, the recession didn't need to be as deep in order to control the inflation.
But if President Biden was hoping that this inflation would prove transitory before the November midterm elections, it seems like that is not going to be the case. And Kim, I think that is a huge part of what is playing into his extremely low popularity numbers, his extremely low numbers on the classic question of, is the country moving in the right direction or in the wrong direction? I frankly think that people have not experienced this much inflation in a long time. In my lifetime, I think people have forgotten how much they really hate inflation. And one notable line, though, is from Biden's statement today. He says, I will continue to give the Federal Reserve the room it needs to help it combat inflation, unquote. But it is hard to see much changing here before voters go to the polls and give a verdict on who's going to be in control of Congress.
Yeah, I think this gets to Joe's excellent point about accountability. And by the way, I want to say I agree with him entirely that I don't think unemployment is the cure to this. And guys like Larry Summers often are peddling advice that is worse in the long term because it actually encourages this kind of thinking rather than the right kind of thinking. And this gets to Joe Biden. The White House is obviously very bitter that it's being tagged with this and is constantly attempting to push this off on someone else, whether it be Vladimir Putin or greedy manufacturers or greedy oil speculators or greedy meat stalkers, whatever it is. But the reality is, and I think this gets to some of Joe's point here, this is partly or largely Biden imposed as well, too, in that if you're looking at the demand side and the supply side, he has done absolutely nothing. And in fact, he has made the situation even worse. The constant signal that is coming out of this White House to corporate America and even small business America is don't expand, don't increase productivity, don't increase supply, because you've got a world of hurt waiting for you, whether in terms of higher taxes or more regulation. And then add to that as well the kind of wash of money that has flown out last year under the Biden administration, which also needlessly stoked demand and has helped land us in this situation. So I appreciate that they are frustrated, but they're also not doing anything that would arguably help the situation, i.e. by changing direction on policy. In fact, what are we doing right now in Washington? There's a discussion about yet another spending bill, a climate bill in which we would raise taxes on the pass-through income of small businesses. This is nutty, the conversations we're having. And so if the White House wants to help itself, it might actually try to get on the right side of history here, which we know how you make this better. And that is, look back to Reagan's supply side economics. They seem unwilling to do so.
Joe, can you give us a sense of what that kind of a supply side package would look like? And I agree with Kim that President Biden seems really unwilling to consider a change in his tack here. But remember that he ran as the non-socialist, non-Bernie Sanders candidate in the Democratic primary. He said he was going to unite the country. He has decided to govern otherwise, but he could change his mind. Maybe it will take a drubbing in the midterm elections to do it. But if he gets there, what kind of policies do you think he should pursue?
Well, I think a key part of this, first off, would be energy production. If you're in an environment where energy insecurity is a big part of what is driving up prices for everything, whether you're talking about gas prices, home energy prices, the whole point of calling this Putin's price increases is this notion that the Ukraine war is wreaking havoc on energy markets. Why on earth then would you suppress domestic energy production within the U.S.? This is the single part of this whole story that strikes me as absolutely bonkers, that they just refuse to recognize that. And so I think that if you wanted to do a supply side cure to inflation now, it would start with energy production. I think that you would, completely change the way that you were thinking about and talking about tax policy. You would stop dangling that Damocles sword of potential future tax hikes over businesses, individuals, small businesses, because that threat is a big part of what has potentially been hindering productive investment in the economy. You would not be waging the kind of regulatory assault on the economy that so many Biden administrative agencies are doing right now. Again, because you would be thinking in a much more serious way about the effect that all of those new rules that they're proposing is going to have on productive investment on the supply side of the economy. So, to say the thing is to recognize why this particular administration is unlikely to do any of it. But we should not indulge them in pretending that there's any great mystery about what the solution here would be. It's just that they don't want to do it.
And Kim, we know now that Chuck Schumer, Senate Majority Leader, is negotiating again with West Virginia moderate Joe Manchin, still trying to come up with some kind of reconciliation deal that can pass the Senate. And my understanding is that part of what Joe Manchin wants is some kind kind of useful energy reforms. And is your skepticism just that anything realistic that he wants wouldn't be able to pass through the leftmost members of the Democratic Senate and the Democratic House? Or is it that whatever good he gets in that bill would be swamped by the spending and the tax increases and everything else? Or maybe it's a little bit of both?
I think it's both. And I'd like to salute Joe Manchin for being perhaps the only Senate Democrat who is using this negotiation as an attempt, as it were, to put some protections around fossil fuel industries that have been so under assault by every other part of the government and his colleagues. My concern with this is that he seems to be approaching this more from a position of weakness because he is 1 against 49. And while that does give him an enormous amount of leverage, he seems to have approached this as, well, I'm going to just take what I can get and also therefore let my colleagues have a whole bunch of what they want as well too as part of a compromise. And I'm very fearful that if any of this were to come up, yes, he might get a little bit of breathing room around, natural gas producers, electricity providers, and et cetera. But I'm not sure that it would make up for the horrible policy that would be accompanied by that. Now, the good news from my mind is that this still has a lot of hurdles it would need to overcome. They appear to have done a very small piece of it, which is an agreement on allowing the government to negotiate over Medicare drug pricing, and that would, in theory, raise some money for the federal government. There's also a talk about tax hikes. There appears to be some agreement. There is still massive disagreement on what would come as part of that energy provision. A lot of people like Bernie Sanders seem completely unwilling to do anything like this if it is a green light at all to fossil fuels, or unless they get some sort of climate lever, something that allows them to outright regulate climate emissions. You've also got, interestingly, a number of House Democrats that are saying if you guys are going to do anything with taxes, you once again have to deal with the state and local tax deduction issue, which we're really unhappy about. That's an enormous, expensive issue, so no understanding how that will happen. I'm not sure we're close anywhere here, but I just would, again, repeat how crazy it is that we're having any discussion about any further tax hikes right now at this stage in the economy.
Thank you, Kim and Joe. Thank you all for listening. You can email us at pwpodcast@wsj.com. If you like the show, please hit that subscribe button on your favorite podcast app, and we'll be back tomorrow with another edition of Potomac Watch.